Welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm Leslie Picker, in for Bob Pisani today. Joining us today is Todd Rosenbluth of CFRA and Matt Bartolini of State Street. Let's start with the sell-off continuing today with the S&P, Dow, and NASDAQ all on track for the first negative month of the year and trading near three-month lows. The sell in May theme in full effect as U.S. equity ETFs see roughly $7 billion in outflows just this month. This as investors have been rushing for safety in fixed income, quality, and low volatility ETFs. So just how much worse could the sell-off get, and where should investors go to hide? Matt, we'll start with you.
So, I think where we are in the market cycle with slowing economic growth and slowing profits, investors should really target quality but don't overpay, because that can provide a little bit of margin of safety if these microbursts of volatility really extend themselves.
And Todd, where do you think investors can see opportunity in the current environment?
Yeah, well, we at CFRA think we're going to see a bounce back in June. That typically has happened when there's been a sell-off like we've had in May historically, but we've seen inflows into quality. Matt mentioned, so the quality ETF QUAL from iShares saw some strong inflows. We've seen minimum or low volatility ETFs like SPLV or USMV see strong interest, and we think dividend strategies are a good place to be able to go. If you're looking at SDY from State Street or NOBL, which is from ProShares, those are good places to be able to hide in the marketplace, get some income, and ride out some of this volatility that we're likely to have during the summer.
Matt, do you agree, sell in May and maybe stick around for some better days in June, as Todd was suggesting?
Well, I think investors should broadly stay invested, just given that we're continuing to have accommodative monetary policies and fiscal stimulus that is likely to continue. So I think what this just tells us that investors are willing to stay invested but move towards more high quality names with sustainable cash flows and high quality balance sheets, because typically in an economic slowdown, those are the type of stocks that tend to outperform.
Todd, in terms of hedging using ETFs, are there specific areas that may kind of counterbalance some of the quality ETFs that you're looking at right now?
Yeah, well, you could also rotate into some of the defensive sectors. Consumer staples, healthcare have historically done well during these periods of time. And you've got ETFs like XLV, the healthcare ETF from State Street. You've got VDC, the Vanguard Consumer Staples ETF. Investors have done well rotating during this volatile periods of time. Instead of hiding in the marketplace, you can be able to do that to hedge out some of the risk that's out there in the market and be able to rotate, not just necessarily retreat from the broader market sell-off.
Matt, do you see people using ETFs more in uncertain environments like these rather than making a kind of specific stock play? They just turn more broadly to ETFs in order to diversify their portfolios a bit more.
Yeah, we continue to see rotations from ETFs. So as Todd was saying, we've seen some rotations within sectors to the more defensive segments, but again, more rotations into fixed income ETFs to really provide that portfolio ballast during times of volatility. We've seen government and aggregate exposures take in assets in the month of May as the equity market sells off. And I think that really just shows the sophisticated and tactical nature that ETFs can provide for clients that are moving in and out of the market based on the latest information.